Well, the talk of town is semiconductor, and we're going to talk a little bit about that today. We're going to talk to Kaynes Tech, which is foraying into that space. Welcome to KYC. I'm Harsh Saita. With me is Puneet Javeri. He tracks that space very, very closely, and therefore he's going to be joining. Let me quickly try and pull out as to what I want to know with regard to Kaynes Tech. Firstly, in particular, you're seeing an inventory cycle which they've spoken about a possible improvement in, but there is pressure on cash flow, especially with regard to this part. The inventory days are expected to improve, but of course we'll have to wait and watch as to how much can it improve and how quickly can it improve. So that's the first thing I want to know. The second one is with regard to the semiconductor foray itself. How quickly can it start contributing? They've guided that it will happen as quick as FY26 itself. We had the Prime Minister also comment on it, and he suggested that it will happen by end of this calendar year itself, is what he indicated, that Kaynes Tech will start producing semiconductors by. And therefore, that obviously gives it a new tilt, given that you have the PM's comments coming through. The third piece is that FY26, they've guided for 4,500 crore of top line. I want to know what the revenue mix will be, whether there's an upside possibility to margins as a result of that, and what the FY27 outlook really looks like, because they are currently doing sub 2,800 crore in top line. 4,500 crore is a steep ask. They'll likely do that given the strong order book as well as the foray into semiconductors. Puneet can correct me if he feels I'm going wrong anywhere. But FY27 is where the entire full weight of semiconductors will be felt in terms of how the top line evolves. And that's where I want to know where the top line goes to. So both of those levers, what happens as a result to margins, I did speak about that. Also, there is CAPEX. And along with the CAPEX comes funding. They've done an equity raise recently, but what plans with regard to funding? And because it's a large amount of CAPEX that they are planning, 4,000 crore plus for a company which I just suggested did sub 3,000 crore in terms of top line. So you're seeing very, very strong CAPEX plans come through. What the debt outlook is going to look like. They've also done a few acquisitions, Puneet, and we were just talking about that before the start of this. I wonder what levers they have with regard to those acquisitions which come in as well. So that's probably point number 8, which I'd want to know if we have the time and the bandwidth for that. But Puneet, I'll allow you to start with the company itself. You know it the best, so
well, definitely it's been one of the key players in the EMS space. You know, we do talk about Dixon as one of the leading manufacturers. Kaynes Tech definitely is, you know, in terms of top 2 now because of the revenue disparity as well. We do mention a lot about Dixon Technologies, but Kaynes leading manufacturer in terms of design as well as manufacturing partner for electronics, and the margin profile is key here because it's almost 3 to 4 times that of Dixon Tech, even while the revenue is almost 75% below that of Dixon Tech. So you see the two ends essentially of the EMS business. It makes products essentially for cars, railway industry, aerospace, healthcare, and what they call as industrial, which includes smart meters amongst other products. So that's one. They have around 16 plants in India, expanding globally, and one of the key pointers is acquisitions. So they did acquire August Electronics in a few months ago. That has given them another plant in Canada, and that is the growth aspirations. Strong focus on R&D has been one of the key aspects for Kaynes Tech to move into the semiconductor vertical as well. And that's one of the key reasons that differentiates them in terms of just OEM manufacturer essentially for the other players. So there is that key differentiation for someone like Kaynes Tech as well. These are some of the key products, you know, within the auto products. They do have lighting, electronic controls, amongst others. They do work with a lot of electric vehicle companies in terms of sourcing of those products as well. That's one. The other ones, of course, smart meters, and industrials now contributes almost 50 to 55% of the company's revenue. And hence we see this kind of, you know, growth aspirations because these are all new verticals. Smart meters is now just booming right now. Railways as well as aerospace is also a very new vertical with defense also coming up as well. But those seem to be the two key segments. They contribute roughly 75 to 80% of the revenues. They have some others as well. Let's pull those up very quickly. Medical is one. They've done an acquisition about a couple of years ago, doing very well with X-ray units as well as monitors. And finally, they have something called IoT products. This is again a very, very new segment. I think the growth will largely come in FY28 and 29 from these ones as well. But let me toss it back to you for the other bit about the company.
Yeah, let's pull up the mix. There you go. So that's probably the only piece left. Industrial and EV is around 56%. Auto is around 26%. So that's a large part of it. IoT is just about 8%, but is fast growing, as Puneet suggested. There's railways as well, which contributes around 7%. Medical, again, one of those levers which can be fast growing, and aerospace as well, just 1% currently. But again, one of those which can grow extremely fast. I'd also want to see what kind of a share OSAT starts to occupy in this pie, because that will also be the other interesting piece. Puneet, any idea as to what direction will OSAT take? Will it be used for their internal products which they are currently manufacturing, or will it be sold standalone as well? How does the semiconductor foray look in your view?
Well, I think a lot will be exported out as well, because they will be using, while a lot is for domestic consumption as well with OSAT, we have nobody right now in India who's doing that. And I think Kaynes would be one of the first companies to actually start manufacturing, as PM Modi also highlighted. So there's a lot of ambiguance essentially in that term, because everybody is more concerned of when is the timeline. I think this might be the first time where you could ask the company of how big could it be, because now the timeline seems to be more set essentially by Q4 of FY26.
Okay, so that's of course the take on semiconductor. That's the big foray which we will speak to management about. But let's talk about all of the metrics which we will be taking on when it comes to Kaynes Tech. That's the first four: income statement, balance sheet, cash flow, return ratios. Thereafter, we look at shareholding, street cred, street coverage, and valuations, and we'll cap it off and give Kaynes Tech our KYC rating. Let me start off with the income statement, or allow Puneet to start off with the income statement. Puneet.
No, so essentially, there's not too much to complain about essentially for Kaynes Tech in terms of revenue growth. It's been stellar. The company listed in November of 2022, and since then, you can see the jump of 57% CAGR over the last 3 years in terms of revenue. That's led by newer verticals like industrial, but it's been a one-way upside essentially across the revenue parameters. EBITDA as well, 64% growth. We've seen the margin profile also improve substantially from 13.5 to 15.3, and now the company is anticipating to go all the way up to 17%. They did 16.8 in Q1 and expects it to maintain, and we'll quiz the management on that. Net profit as well, a 91% CAGR in this particular time frame. The newer acquisitions like August, amongst others, has helped the company improve the margin profile and hence the net profit as well substantially. But no doubt you're Harsh giving this a huge thumbs up.
Yeah, and you can see both levers kicking in so well, both the top line as well as the margins uptick, and that's led to profitability. In terms of sustenance, if you can continue to see both of those levers play out, you could well see sustainability of this kind of profit growth, and that's what the street seems to be building in. Let's talk about the balance sheet, and essentially this is going to be important from a perspective that you already have a very large opportunity, there's no doubt there. But on the back of that, you're going to see a lot of capex which will come through, and therefore you want to look at that balance sheet carefully on whether it's able to take in that kind of capex. You're seeing a decent amount of cash and bank balance, but the borrowing number, the long-term borrowing number is not too large, but the short-term borrowing number is quite elevated, and that's also because of the mismatch in cash flow that we're seeing. Some amount stuck in inventory, some amount stuck in receivables. So all of that needs to unwind to a certain extent. But nonetheless, that amount seems quite large, but the cash balance which the company seems to have is well in place to take care of the kind of debt that they've taken up. So no concerns there. The only worry therefore will be how will the new capex get funded. But that too, from a company which is now worth nearly 50,000 crore, so it's no small company anymore. You don't see these kind of numbers as being too large. but at the same time also understand that it's trading at 15 times book. So it's something that you want to keep in your mind. We've given this a thumbs up because the balance sheet doesn't look altogether bad because of the cash balance that's lying in the balance sheet. But overall, you're seeing short-term debt rise and you want to keep your eye out on that number. Puneet, cash flow.
Well, I'll toss back to you for cash flow because, net cash flow has been very strong. And I think we were discussing that before the show that they have been able to maintain that. But the inventory number is quite high.
Yes.
So, from that perspective, let me toss it back to you for cash flow from operations because that has been in terms in negative. And what could we look at going forward also?
Yeah, Puneet, when I was looking at the numbers, it seemed like there was an elevated number when it comes to cash from operations, which are being sucked into receivables, which are being sucked into inventory, and certain advances which have been paid out. So those three are really sucking in a lot of the cash flow from operations, and which is why you're seeing a negative number there where your CFO is concerned, which doesn't look very pretty. But there has been a guidance that they will reduce inventory slowly and gradually is what the management has suggested. But of course, it's a wait and watch. We have to wait as to how quickly can that inventory unwind happen. And if that were to happen, of course, there'll be an improvement in CFO. But this is clearly one place where the company needs to do some amount of work. That's evident.
Well, definitely. And I think, they have been looking at reducing the number of days as well. It's going around 120 to 130 days.
Correct.
They want to reduce it to 70 to 75,
Correct.
but
yes, I read about that as well.
It's a steep target to say the least, and
Absolutely.
I think that'll be the other one to watch out for. Let me also go across to the next metric that we're also tracking, and that is return ratios as well. Let's pull those up because here is also another where the last 5 years, if you see, the return on capital employed has come down, and we will talk to the management about it. While maintaining 13 to 14%, it's down from the level which was seen in FY22. We saw the companies listing around that time as well in FY23. But there needs to be some improvement in return on capital employed because there are some segments within industrial that do very well in terms of ROCE, while some, the traditional like automotive, drags the ROCE down. So that's the play here because especially for Dixon as well, we see the mobile division have 85% ROCE, while the other divisions like home appliances are at 10 to 11% ROCE. So there is where the company will have to see in terms of which segments that will lead the growth. The ROE as well, let's pull up that very quickly. That is expected to improve substantially from these levels as well. And that is the other one because it's gone down from 16% to 8% in FY25. And the company's performance will improve in terms of profitability. So that's the key metric that we also look at in terms of ROCE for the other EMS players. And it's always relative because we have certain players in the similar segment. But yes, definitely a point where we will take with the management in terms of improving as well.
Yeah, so that's with regard to return ratios. Let's talk about shareholding now. Again, the shareholding for a recently listed company, we've seen the shareholding come off. Some of it is because of fresh issue of equity, and it's a fast-growing company and therefore understandable. The other piece also is that we've seen some amount of promoter stake sale, around 1.7% in terms of promoter stake sale. And therefore, that is something that you again want to watch out for. But it's such a small number and promoters continue to hold over 50%, so no concerns there. We've therefore given this a thumbs up as well because it's quite well held. There's no per se concern around it. Wouldn't you say that, Puneet?
Definitely, and we've seen this, the jump for DIs as well from roughly 17 to 22.
Yes.
And I was just checking because it is a number. So at that time, we saw the dip in the markets in March. Stock fell to 4,200 and then we saw the smart money movement from mutual fund investors. So definitely they've also come in at this particular point of time.
No, absolutely.
The next one is street cred and street coverage. Let's go by one and I'll just cover the street cred very quickly. 39% growth in terms of share price over the last 1 year. It gets interesting as we increase the time frame. The 2 year as well as the 5 years since the company listed, 230% in the last 2 years. And we saw the revenue potential of the company, which has happened in the last 2 years. It's up 8x since its listing in November of 2022. So those who did get in, it was a new and upcoming segment at that time, but definitely it's been one of the multi-bagger stocks to say the least.
Yeah, and let's stack up the valuations as well. Valuations will reflect it slightly on the higher side. even though I'm not so sure with the kind of growth that the company does, how can one look at valuations? But even FY27, you're trading at around 64 times versus a Kaynes Tech of around 64. Now, may not be an absolute comparable to a Kaynes Tech, but nonetheless, it's in the same segment, and that's why we've tried to compare it. And Amber sits at 46 in contrast. So maybe on the higher side of that as well. We're therefore giving this a cautious neutral, but we want to see whether they can beat the numbers in terms of at least the estimates that analysts are penciling in. And therefore, let's bring on board Mr. Jairam P Sampath, whole-time director and CFO at Kaynes Tech, to talk to us about the numbers. While we have the ratings also come up, the KYC rating that Kaynes Tech gets is around 6.5 on 8. Mr. Sampath, it's great having you. Let me first start off with the elephant in the room. What's the expectation on the semiconductor foray? How quickly does it come on board? How quickly do the revenues start translating on your books? Give us that perspective.
Yeah, thank you for having me on the show. And that I was watching part of the analysis, great analysis.
Thank you, sir.
All done. And so fundamentally, the semicon industry, we were the last ones to get approvals. And so we kind of, in some sense, had a feeling that we have a lot of work to do to catch up. And then I think our team has worked day and night. The pilot plant is already ready and producing the OSAT samples. And probably this month we'll complete the first set of samples for our first anchor client. We have acquired about 3 anchor clients, which is much more than what we had anticipated to begin with. And so as of now, I think it's a very positive trend as far as customer coverage is concerned. A lot of our output is actually covered, and also the kind of work that we are doing, these are all new products, and partly driven by the India story, the Atmanirbhar plank. So we are in the intersection of Atmanirbhar and technology together. And that's probably the best spot to be in today. So the global problems don't affect us too much. So fourth quarter, like we have promised, we will start shipping commercially. And prior to that, we would try and do one more customer so that we can have at least 2 customers approved. And for the next year, I think the, let's say, sustained month-to-month revenues will start off. And by the time some more CapExes would have been spent and some more lines would have come, the main plant will come in, if you will. So right now, the 60,000 square feet pilot plant is already ready, world-class actually.
Right.
And then the additional 160,000 square feet is just about to get ready. The building is ready, and we got to do some.
So, Mr. Sampath, it's Puneet this side, and thank you for joining in. I think over the last 2 quarters, we've now established that there won't be any kind of delays essentially in this plant. And from quarter 4 onwards, we should start seeing the business start essentially and have the first full quarter. Is that right?
Yes, absolutely.
So, in terms of your revenue targets, you've given FY26 as 4,500 crores. FY28 would be somewhere around $1 billion, or roughly about 8,000 odd crores. Could we? Is it time that we start talking about what could be the revenue contribution you might see from this business, if not in FY27, in FY28? Because while I know it's an uncertain time, you will add clients overall. There could be some expectation if you can give us that, sir.
Yeah. So obviously, when we do a guidance and a plan, so we work in ranges, right? So whatever we have declared as $1 billion revenue target is the minimum that we think we can get to, even if there are, say, slowdown in a particular segment, there are delays in getting customers, etc., etc. So the target of 9,000 crores by FY28, we assume that rupee and dollar will be about 90 rupees to a dollar. So around that target looks like it's quite visible now. And out of this, originally we had anticipated about 1,500 crores of revenues coming in from semiconductor. And I think we might even cross that if all the plans work the way we have anticipated. And there is the other business, which is the PC board business, which commercial production starts in April. And so why we are saying a little bit conservative numbers in these businesses that this is the first time we are doing it, and unless we have a couple of quarters behind us, we really can't say it with certainty that this will happen and that will happen. But all the signals, all the ingredients are there to, let's say, get about 2,000 crores minimum from the new businesses, out of 1,500 crores from semiconductor and 500 crores from the PC board, and then of course the 7,000 crores comes from our existing ESDM business. And so we are planning for a little more than these numbers in each of these segments so that we can cover any possible, let's say, drops, because a few things most of the things we know, but a few things we don't. So we just want to guard against a situation where something takes us by surprise.
Sure. Mr. Sampath, there's going to be a large capex to enable you to get there. I'm trying to understand where the funding for that comes from. How do you visualize it as of the day we stand today? Is there a thought process with regard to generating a stronger cash flow from operation, which should aid some of the aspirational capex, very, very strong aspirational capex that you have?
No, absolutely. So we have gone to the market 3 times, one during the IPO, second during QIP1 and QIP2. So I think we are done for the time being up to, let's say, a number of about $2 billion turnover, which we probably have soon after FY28, maybe FY30 or thereabouts. And so we have factored in all the capexes that are required based on whatever implementation schedule and execution possibilities that we have, abilities that we have. And so no more further money will be required to be raised. Maybe we'll do some short-term debt to take care of maybe possible time lags for getting the subsidies. A lot of new projects, capex is being subsidized by the central and state government, for which we are very grateful, and that helps us to really charge up the project's implementation speed very much, because capital, customer and capital, they are the two, let's say, most important things for any business. And then, so fortunately for us, even customers there for the new businesses, and the capital is also there. So as far as cash flow generation is concerned, so there is in our balance sheet, which we have published, actually, you can see there's a small blip last year in the receivables portion, which is one of the companies that we had acquired had, let's say, a legacy term for receivables. These are receivables not due, more by the way of annuity payments and so on. So we're trying to look for some financing options so that we can get this off our books. And from that perspective, we probably will reach a 70-day net working capital by end of this year. And definitely positive operating cash flows for sure. Free cash flows, I'm not so sure, because we'll keep investing. This is a hungry machine right now.
Right. So
it needs to be fed with the capex. So just to give you a ballpark, we are adequately capitalized in the EMS business to grow at a potential rate of 50%. So whatever capexes you require in the EMS business to grow at 50%, I think we can fund it through internal resources.
Right.
Similarly, in the other two businesses like Semicon and so on, some back of the envelope calculations only.
Yeah.
Semicon, we can grow at about 15% from the cash that's generated. Of course, in Semicon assembly, the full-fledged operations will be probably operational by FY28 and FY30 timeframe.
Yeah.
So thereafter, you will have 15% growth, which can be self-funded by the cash generated. Similarly, in PC board business, it's our calculation that we can grow at about 20% without raising any further funds. But of course, these are all with a caveat saying that we are not citing any major, hugely strategic and new projects and so on and so forth. In case that happens, then we'll have to think about how to finance them. But
fair, Mr. Sampath, because you are giving a lot of guidance in an uncertain world. So that is definitely point taken. And just one question, the India Semiconductor Mission 2.0, that's been one of the most talked about key aspects of, a lot of players have given their aspirations to enter this business, semiconductor business. If you can give us some perspective of what kind of conversations, if any, you've had with the government on that, and your projections of any kind of future business depend on that kind of subsidies as well. So if you can give us some perspective.
Yeah. So I think subsidies are a great way to start off people's inhibition, get over people's inhibitions to invest into newer businesses. And when we came into this particular field, of course, we've been eyeing this business for about 5 to 7 years prior to actually even listing. We've always been visiting these companies and wondering what is it that they do and why is it that they are doing what they are doing. Is there a possibility of synergy between EMS and these kinds of businesses, etc.? We are glad that we got that equation right, and I think today our decision stands vindicated that we are getting into these areas partly as something like a backward integration and partly as also to participate in the technology leadership in the manufacturing arena. Now, as far as semiconductor is concerned, obviously we have to start off with the basics, so which is the wire bonding and legacy packaging and those kinds of things. There also we are careful in choosing those which have a lot of implementation in India, like modules and so on. So they also not only help the company to make a little more money, but we also participate in nation development by making sure that the critical parts are made in India. Similarly, for PC boards, we're also talking about further backward integration at some point in time once we get approvals and so on. So the idea is that when we participate in the demand from Atmanirbhar Bharat plank, we think that we should take leadership in getting technologies right here. And that's going to add, that's a win-win. It's a win for the country because you have control over critical technology. B, it's win for the company because we make a lot of money. You have to buy all these things at a high cost from outside countries, So so we think that what government is doing is absolutely correct. Whatever they can afford, we should put it into capital subsidies. And help people to set up new technology and high-tech ventures. So that it's like if you recall, I just take a half a minute to tell you. If you recall, we missed the entire electric typewriter and electronic typewriter boom, right? We went from manual typewriters to computers. And leapfrogging is something that India is good at, and we should do that. And so leapfrogging is not possible if capital subsidies are not given.
Sure. No, sir, absolutely. I believe the government has heard you loud and clear. Sir, your guidance kind of signals that we're at the cusp of achieving exactly what you are suggesting. So thank you so much, sir, for coming in and giving us that perspective. But out of time on this edition of KYC, from Puneet, myself, and everyone who puts this show together, thanks so much for watching. Stay with us on NDTV Profit. More action on the other side.